Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cashflow podcast, where our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. Now, our guest for this week's show is a real estate, a multifamily investor and syndicator, Neal Bawa. Now, Neal is the president and CEO of Grocapitus, a commercial real estate investment company that specializes in multifamily investments. Neal has an extensive background in technology as a data scientist, which he's applied to his real estate endeavors. Now, leveraging this experience has allowed Neal to identify high growth markets and build a portfolio worth in excess of $1 billion. And so with that, guys, it's an honor to welcome Neal Bawa back to the show. Neal, how you doing today?
Fantastic. Great to be back on the show. Great to spend some more time with you, Kevin. I really admire some of the things that you've done and the path that the path that you've taken that's not well trodden upon, I would say. And so it's great to be back.
Yeah, no, I'm excited to have you back here. And yeah, we were joking about that earlier, our niche investments in parking and mobile home parks. And so, yeah, we try to be somewhat contrarian. And I know that's, we're going to talk about that a little bit today, because I think that, before we start recording here, we were talking about kind of what you're up to and some of the approaches that you're taking. You were kind of just stand off a little bit for the last couple of years, just watching the craziness ensue in the multifamily space, and knew that ultimately there would be some pain coming down the pike. And again, I don't want to spoil it, but we'll chat about that and what you're up to nowadays. But Neal, before we get too far ahead of ourselves, maybe take a moment, if you would. I gave you such a brief introduction there. There's probably a handful of listeners multiple handfuls that know who you are and have seen you speak, present, heard you on podcasts. But for those that might not know who you are, what you're all about, what it is you do, take a few moments and tell us a little more about yourself.
Sure. I'm a computer science major, technologist. Data science is my key focus. I've had a successful technology career of 15 years. I've had a successful technology exit by selling a company at class-leading multiples. And I've been doing real estate for the last 2 decades. The first decade was just on my own, both building campuses for my technology company, no investors, no splits, nothing like that, just cash from my company, built office campuses, custom built them. And then I went out and bought lots of properties of my own, dozens of my own, just because I live in California and I had a huge, W-2 salary, and I was paying 50+% of my income. And so bought lots and lots of real estate and published a massive amount of research on the use of data science in real estate. And that sort of went on for 10 years. And eventually, when I exited from my technology company, I'd already built a platform, and there were already thousands of people that were aware of what I was doing. And so the transition was sort of seamless. So basically been involved in syndication since 2014. Currently have 950 investors, mostly as geeky and dorky and nerdy as I am. And a lot of them are Silicon Valley doctors, scientists, technologists. And they sort of enjoy what I do, not just from the perspective of the assets that I buy, about $1 billion worth, about 35 projects. They also enjoy the process. So we really involve our investors in how the heck am I figuring out that Rogers, Arkansas is the best place in America to invest right now? By the way, that's a comment that I'm making, that Rogers, Arkansas is the best place in America to invest right now. How did we come to that conclusion? Whether we're right or wrong, we went through a very long process to figure that out. And our investors, because they're geeks, they really like being involved in that process.
No, it's fantastic, and I'm excited to maybe explore and dissect the Rogers, Arkansas thing. But no, I appreciate that background, and so let's talk about where we're at today. We chatted a little bit before we jumped in here, and just since 2014, you've been buying multifamily for the most part. I know that you also got your hands involved in a number of different build to rent communities, a few years back, and so again, we find ourselves in a very unique time right now. Everyone knew that the Fed was going to start pushing rates. I don't think many believe that they would do it as aggressive and as quickly as what they have thrown, just the real estate world to a certain degree in turmoil. And there's a lot of ensuing pain out there as it relates to debt maturities that are coming due, and a number of deals that are already underwater, and just lots of things happening, right? And so we'd love to hear, I guess just really what your business looks like today. First question would be what your business looks like today in comparison to, what you were doing 2 years ago. What has changed?
Absolutely. I'd love to answer that question, but I want to set the groundwork for it by sharing an article that came out on August 7th.
Hmm.
So this is August 7th of 2023, and the article's from Globe Street, and it says, "This is how bad retail and office valuation drops have gotten." That's the title of the article. The article says that Trepp recently reported valuations for different kinds of asset classes, including multifamily, but not limited to multifamily. And so
Hmm.
they had a company called CredIQ, which basically does appraisals, grab 190 major properties across many different asset classes. And the question that they were trying to figure out is these current market conditions, which are highly unusual, by the way. The Fed has never raised rates so quickly and so fast and so high in history. They've been higher before in the 1982 crisis when inflation was running high, but they were raised over a longer period of time,
Hmm.
right? Here, the speed has been absolutely astonishing. What Trepp wanted to do is to figure out how much of an impact has it really had on the whole industry, right? We know that the impact on single family has been almost negligible because of locked in rates. 2/3 of all mortgages in the single family market were locked in at 4% or below. And as a result, we've seen single family prices decline by maybe 2%, 2.5%. So they did go down about 4%, then they bounced back up because of the spring season. Might go down another few percent, but there's nobody in that industry that considers this to be a problem for rates to go up 500 basis points and for prices to go down 2 or 3%. So that market has been astonishing, right? So now CredIQ comes in and says, okay, we looked at 190 properties in the United States. Where did they go? Here are the numbers. And some of these are going to shock you, right? Retail properties, and in this set of 190 properties, were down in value by 57%. 57%.
Wow.
Office wasn't down as much, even though most people would consider that to be the one that would go down the most. But keep in mind, office leases are usually 5 and 10 years long. So office is a slow process. They don't usually sign more than 20% of their leases in a given year. So it takes a long time for offices to empty out. Offices were down at 48.7%. Still an absolutely insane number. Next up was mixed use. Mixed use is basically a bunch of apartments, and usually there's retail or like sometimes there's a hotel. Basically you're blending a bunch of different things together in one place, and they were down about 41.9%. All three of these numbers, right? 57%, 48.7%, 41.9%. These are astonishing numbers because we didn't even get these sorts of drops in 2008, right? In the commercial sector, right? We got pretty big drops, but they were nowhere near this level, right? And then you look at the good ones, the ones that haven't dropped that much. The two big ones there are multifamily, down 22%, and industrial, down 21%. So you sort of neck to neck. These are the two preferred asset classes that people have talked about for the last 5 years. People have, if you go out and do an analysis of the big investors, the billion, 10 billion, $100 billion investors, and people do that annually, and basically ask them to rank their preferred asset classes the last 5 years. Each year, it's been multifamily and industrial, or industrial and multifamily, and you can see the impact of that in their values going down by 21, 22% each. And then the shocker was self-storage. For reasons that I don't fully understand, self-storage valuations were down 0%. Now, self-storage is having problems. Their rents are down a lot, their occupancy is down a lot, but the values, the cap rate valuation has not declined yet. It might decline, but still, pat on the back to self-storage. I'm not in that business, but so this sets the groundwork for how massive this is, right? We're talking, if you combine multifamily with commercial real estate, we're talking about asset classes that are trillions and trillions of dollars, right? Thousands of billions of dollars. And to see numbers that even for multifamily, 22%, that's a number that's incredible, right? That is stunning. And we've never seen this before. Well, maybe
Just so we
2008.
have added context, what was the time frame that they referenced it back to?
So basically what they looked at is from peak. And I'm guessing, and this isn't in the article, I'm guessing that the peak was different for different asset classes. So we know that the peak for office was back in 2019. Pre-COVID was when office was just booming. San Francisco, $1,000 a square foot, all that kind of crazy madness, right? So that was around 2019. Retail, I think, was also around that time frame pre-COVID. And then multifamily, I'm pretty darn sure that it was either Q4 of 2021 or Q1 of 2022, because those times I was selling a bunch of properties. I just could not believe the prices that I was getting. I was just stunned. I sold a property, a really old property, sort of beat up property that I had in Tucson. I bought it for $55,000 a door the year before COVID, and I sold it for $183,000 a door. That, just think about it, right? I mean, you typically want to sell your property for 50% more to double your investors' money, right? So if you buy it for 10 million, you want to sell it for 15 because you're using arbitrage, right? You're using a lot of loans. Your equity might only be $4 million. So if you sell, buy for 10, sell for 15, you might not get 2x, but you'll do well. If you're 16, 17, you're great, right? But if you take a property that's $55,000 a door and sell it for 183, you're in a bubble. And so multifamily, it was that Q4 of 2021, Q1 of 2022, that's likely to be the from peak.
Yeah. Could one argue, though, that maybe some of those peak prices were artificially fueled by incredibly low or record low interest rates?
Absolutely. I do not believe that multifamily prices were rational. I also, but you can't really say that for office because the office peak was actually in
I agree.
2019.
I
So
agree.
in 2019, interest rates were normal. They were like completely like, the Fed funds rate was around 2.25. It was just a regular normal market. So I think what's really happened with office is much more dramatic than multifamily. I think if I was to pick multifamily prices a year before that peak, I don't think we're down 22%. I think then we're down more like 10%.
Yeah,
And
I
that
agree with you.
10%
Yeah.
is that normal impact of interest rates being high and prices coming down as a result. So yeah, so multifamily had a very short peak. Often had a pretty long, big peak in that 2018, 2019 timeframe. So there's just complete and utter apocalypse happening for retail and office right now. Even though the retail values I think are the biggest, in my mind, that's the opportunity. I mean, if I had to pick one opportunity in the United States and say this is the best opportunity in America today, the answer is retail. Why? Because retail had actually recovered. Retail had retooled itself. Retail had reinvented itself. Sure, lots of malls closed. They needed to close because there were too many malls, right? But what was left of retail was actually a pretty good asset class. And then it's down 57% simply because banks, right? That means it's down banks, right? That's the answer. Mid-level banks had 40+% of their money was in retail. That number no longer is viable. So obviously they're not, doing new loans. And because the values have fallen so much, you can't get refinanced. And so they fall even more. So you have this cycle of,
Yeah.
this downward spiral that retail's in. It, in my mind, does not represent true value. I don't see why retail in the United States should be down 57.
I
On
agree.
the other hand, office at 48%, I think
That
that's
makes
still
sense.
overpriced. I mean, office is still
Yeah.
overpriced. You know why? Because they have a fundamental demand problem for the next
That's
decade,
yeah.
right? Retail doesn't have that. Retail actually was doing pretty well and still continues to do pretty well. There's still people flooding into malls and strip malls and things like that. So we're not seeing huge vacancy issues. It's just a valuation problem because they don't have Fannie Mae and Freddie Mac backing them up like multifamily does. And so nobody wants to do loans anymore.
Yeah. It's interesting with the office as well is some of the data out there with regards to, current vacancy and various different submarkets. What it doesn't take into account is the actual subleased space. Because that space still has a lease in place on it. So it's still economically occupied. But given that it's currently vacant and it's up for sublease, inevitably, if it doesn't get filled, when that term comes due, it's going to increase the overall economic occupancy of that building. And there's a substantial amount of sublease space available throughout the U.S. So I don't know what's your
right?
your
Quarter
take on
after
the
quarter, it's increasing.
yeah
And that's what
yeah
I'm afraid of.
yeah. So what is the so that is there any opportunity? I mean, I know that there's certain conversions happening, but it's such a small contingent, right? Converting office to multifamily residential or some type of mixed use. But I mean, what does your crystal ball, what does the landscape look like over the next 10 years for office? Is there opportunity there?
So first thing I'll say is there is no opportunity in offices, and anyone getting into offices at this point is going to lose, all of their investors' money. And I'll explain why. the first thing I hear about is conversion, right? So we'll take a downtown office
Hmm.
building and we'll convert it. The two most popular seem to be, or three most popular is, I'll convert it to multifamily, I'll convert it to condos, or I'll convert it to hotels,
Hmm.
right? Those are the three. Right. Now, let's go through them. Number one, only 3% of the offices in New York City are eligible for conversion. And the reason is, there's only a single reason, but it's massive. It's an elephant in the room. Offices usually have what is known as a floor plate, right? The floor plate is basically one floor of the office. Now, to convert to multifamily or hotel, right, or condos, every single unit needs to have a window, which means that you're basically going to end up converting the corner of the floor plate, and the middle half is lost because the middle
Yeah.
half has no windows. And there's legal requirements, there's the builder requirements for you to have window space to call a room. You can't call it a room if it doesn't have a window, right? So what I'm finding, and it's not me, a comprehensive analysis of New York office buildings said only 3% of these buildings can be efficiently converted.
Okay.
And then they went on to say that those 3%, right now, nobody wants to fund them. You can't find any money
Right.
to convert
Right.
them because the buildings are still too expensive. In San Francisco, for instance, the peak of downtown buildings, and this is a very specific building, the Wells Fargo building, at its peak in 2019, it was worth $1,000 a square foot. It sold 2 weeks ago for $200 a square foot, so that's an
Hmm.
80% decline. Here's the number that everyone needs to understand. For that building to economically be converted, it needed to be sold for $95 a square foot. That would be a 95% reduction. Obviously, that's an extreme example, but what I'm pointing out is conversion is an extraordinarily difficult process. And the biggest reason for that is plumbing, apart from the
Hmm.
big issue that I mentioned. The second issue is plumbing. Usually on offices, the plumbing core is one corner, right? Well, here's the thing. You now need to basically cut concrete and bring plumbing all over the place. That's actually more expensive to do than building a building from
Sure.
scratch, right? So hotels can be very easily converted to condos or to multifamily because they've got plumbing everywhere, right?
Hmm.
Converting offices is almost impossible.
It almost seems as though you, in order to create an effective conversion, you'd almost have to get the basis as far as like land value. Like you'd have to be able to buy the entirety of that building for essentially what the land value is. Would
Unfortunately,
you
that's
agree with
true.
that?
Absolutely. In a
Yeah.
majority of cases, right? And
Yeah.
let's say that the building is very narrow and it's long and narrow. In that case, you've got some value there because you've got a lot of window space, right? And so if it's a shallow building, then maybe you've got some value there. But otherwise, it's not going to happen. I am saying this. Companies that do conversions for a living are going to do well because they're going to have more options. They're going to have a lot more options, more than they can even deal with. But
Hmm.
that's a very, very narrow niche of people that know exactly what they're doing and they pick a specific kind of building and do a specific thing with it. This
Yeah.
is not a large scale phenomenon. Mayors of New York and San Francisco have already said we don't consider conversion to be a large opportunity.
Have you seen any other unique uses for these office? But I think it's going to take some time to really play out. But I mean, so with what you're saying, again, such a small contingent even would qualify or make good candidates for a conversion into a multifamily. And so, what happens? What happens just with the glutton of vacant office space all across the United States? What happens to it?
Values at first have to fall, and I think that they're going to fall by at least 60 or 70%. Now
Mhm.
I mean, obviously I'm not talking about all office, right? So class A office is doing pretty well. Their
Yeah.
occupancy is still reasonable. They're not making any money, but they're not losing money. They're not giving keys back for the
Hmm.
most part. So they're just going to muddle through, right? Class A. It's class B that is really, really suffering because now people can get much cheaper leases and go to class A. So why would they go to class B?
Yeah.
So B and C are really, really suffering. Um, the truth is we're just going to deal with an extraordinarily high level of occupant or
Yeah.
vacancy for 3 or 4 years until values fall to the point where an alternate use
Yeah.
emerges. I mean, there's actually people that believe that self storage is better because for
Hmm.
self storage you don't need plumbing, right?
Yeah.
And for
Interesting.
self-storage, you don't need windows. So it's a downtown core. You already have elevator shafts. You're not using much space for the bathroom, so you
Yeah.
can destroy the bathrooms and you basically build self-storage. But again, values have to fall by 60 or 70% for self-storage to become viable.
Yeah, interesting. Yeah, that'd be an interesting use for sure. And you probably already have a freight elevator in a lot of those buildings. So
A ton of them have freight elevators, right?
yeah,
So
yeah,
I think it works. You just basically build a parking area below where you can, pull the trucks up, and then you basically go into the freight elevator, bring your stuff down straight into the truck, and drive away.
yeah. So let's, speaking to multifamily, we kind of both agreed that if you back up a little bit, not at the the pricing at the peak, we felt it was a little inflated. But if you back up and take maybe the pricing of multifamily of what it was, call it pre-pandemic or right at the beginning of the pandemic to where it has fallen today, somewhere 10 to 12%. We can agree on that number. I think you said 10, but 10 to
Absolutely. Yeah.
12% discount. What are you doing? Are you is that getting you back in the ring, or tell us about what your business looks like today? What are you active in?
Okay. Absolutely. I'm back in the ring. After 2 years, there's 100 podcasts, which basically are me saying, you shouldn't be in the ring. You should be on the sidelines. Don't do it. Don't do it. Don't do it. The math doesn't support it. Well, unfortunately, I mean, I used to teach multifamily boot camps. I stopped doing them, after COVID hit. Unfortunately, my students didn't listen to me. And I have some students that have done 6 cash calls in the last, 12 months, and I feel for them. These are good people. They're trying their level best. They just weren't investing in the right time frame because they didn't have context from prior crashes.
Mhm.
So as of July 1st of this year, I am back in the market. I am a dollar cost averaging person. Dollar cost averaging is a stock market concept, which basically says that no one can ever time the bottom because the number of factors that affect the bottom are so many that no computer can compute it, right? And human beings certainly can. So when you get to the point where you're convinced that you're receiving a significant discount, don't buy it in an aggressive way, but keep buying and buy as you go down the curve and then buy as you come back up to curve. So let's say we are at a 12% discount now. I want to buy one at 12%, one at 13, one at 15, one at 16, 17, 19. And then at some point, I'll be buying less. It'll be 13, 12, 10, and then stop. And what you built is a smile or a U curve where some property of yours it was at the bottom. That is the only way that anyone, including the stock market, has ever figured out how to time the market and hit the bottom. And I believe that the start of that U curve is now. And the opportunity is only about 15 months. So Q3, Q4 of this year, and then Q1, Q2, Q3 of next year. Reasons are straightforward. Multifamily is still the preferred asset class, and it's now much more preferred. Just so most people don't know this, but before the early 2000s, office was twice the size of multifamily as an asset class in terms of dollars. So it was the preferred asset class. Everyone wanted to be in office. Who wants to deal with people that only have $400 in the bank when I could work with companies that have a $400 million in the bank? So it was the preferred asset class. Things have changed over time. And now with the 10-year long office debacle, there's still a lot of office operators that have a huge amount of money and they're saying, I want to be in this multifamily asset class. I want to be a landlord. So that money is not in the market today. No one's making that investment. No one's putting money into the marketplace. They're sitting on the sideline. Now I'm beginning to see them come in. Now I'm beginning to see, I have this newsletter that basically tells me what institutional capital is doing, even though I don't get money from them. It tells me that there is definitely huge movement where institutional capital says it's time to come off the sidelines. I don't think it lasts forever for a bunch of reasons. One is there's money on the sidelines that only wants discounts, and they're now beginning to get those. Not the best discounts, but discounts for sure. The second piece is this. There's all this talk about the thousands of properties that are going to change hands or go back to the banks. The numbers are straightforward. There's 105,000 institutional grade multifamily properties in the United States. Of those, only 2,500 were purchased in the last 3 years with floating rate debt and currently are bleeding. Bleeding simply means that you take all of their expenses and all of their income and you match that up against the mortgage and there's a shortfall. And some of those are bleeding by $10,000 a month, so it really doesn't matter. Some are bleeding by 20, really doesn't matter. Some are bleeding by 100. Oh, that's a major problem. Some are bleeding by hundreds of thousands. Well, they're
Mhm.
in the Jesus can't save you category. They're going to go back to the bank, right? So bottom line is, when you look at it, 2,000 properties seems like a very large number. But when you realize that the multifamily institutional market is 105,000 properties, and of them 2,500 are in distress, then you get a sense of context. right?
Yeah.
That, oh yeah, there's going to be distress. Properties are going to be sold for cheaper prices. It's already happening. I'll give you an example. But distress also ends because the total number of these properties that are going to be sold in the next 15 to 18 months is 2,000. And people like me are going to enjoy those discounts, and then that distress will end. The distress will also end because I'm one of those strong believers that believes that cap rates have, basically spiked, from God knows where. If you believe that cap rates at peak were 4, well, they're 5.3, 5.4 now. It's a huge spike. I believe they're going to retrench by about 60 basis points. Not back to the madness. It'll never happen, right? But they're going to retrench because cap rates, just like we have had a smooth increase in cap rates with a smooth increase in interest rates. If you track those two together, they're almost identical. What does that tell you? Cap rates are dependent on interest rates. At some point, interest rates are going to start to decline slowly, not zoom, but slowly. And then we expect cap rates to start to decline slowly again. So in about 18 months, the cap rates are going to hit the point where higher valuations will be supported. Higher valuations support higher LTVs, higher loan amounts, allowing some of these distressed properties, the better ones, to start to refinance if they can kick the can down the roads for 18 months. So my feeling is 2,500 properties, 1,000 of them cannot be saved. 500 of them, the banks are going to work with them, kick the can down the road. The remaining 1,000 will come to market, even though they probably didn't need to, at some smaller level of distress, and will basically see some discounts from there.
Yeah.
But it's not the end of the market. It's not the apocalypse.
Well, give me, if you would, provide some additional context on your thoughts on rates and them trending back downward, and
Sure.
timing wise, where do you think they're going to bottom out, or what does that look like the next call it 12 to 24 months?
Of course. So we're in August this year, and I'm basically making a straightforward statement that I've been hesitant to make until about a month ago. Rates are done. The Fed will not raise rates in September, so please send me a nasty gram if I was wrong. The Fed will not raise in September, and they will not raise in November, and they will not raise in December. They have 3 chances to raise rates. We have 3 meetings left. They will not raise rates at any of those. I also predict that they will not drop rates at any of those because they really have little incentive at this point to drop rates. So when we're recording this in early August, there are clear signs of disinflation in the US economy. I used to have a presentation it's called Real Estate Trends. I do it early in the year that 3,000 people watch it. Early in the year, one of the biggest sections was inflation. Then usually in July, I redo that presentation and I call it Real Estate Trends Mid-Year Update, right? There is no inflation section, but there is a new section. It's called Evidence of Disinflation. It goes into details on how shipping cost containers have dropped from $11,500 to $1,400, lower than COVID, by the way. Even if you don't adjust for inflation, still lower than COVID. And goes on and basically shows 24 indicators that all indicate a small amount of disinflation. Again, sky's not falling, but there's disinflation. The Fed knows these things, but the Fed publicly has to be very, very careful not to point to them, because if they do, then the stock market goes crazy. And the Fed really doesn't like when the stock market all of a sudden says, the Fed is done, right? Buy everything in sight. I mean, it's the nature of the stock market to be completely insane. And the Fed wants to curb that. So they're very, very, very careful with the statements that they make about disinflation. But if there's very clear evidence in August, please type in the word disinflation into Google, click on news, and you'll immediately see several dozen articles about disinflation, not just in the US economy, but in China, because China is clearly doing really poorly as an economy. So I'll go back to your question, right? Are they going to raise any more? No. Are they going to drop rates this year? No. Are they going to drop rates next year? Yes. Are they going to drop really quickly? Heck no. But I think you're going to start seeing, a half-point drop in the first half of next year, and then maybe a half-point drop in the second half of next year. Now, is this something original that I'm saying? No, because the Fed's dot plot, which is what they publish every time they come out of one of their meetings, clearly says that. The dot plot says rates are going to go down by 100 basis points by the end of 2024. And the dot plot is the most conservative of everything that the market does. The market thinks that they're going to come down much faster. I think it's bullshit. Morningstar thinks they're going to come down even faster, and they're the sort of the biggest forecaster of interest rates. I think everyone's wrong. I think the Fed's right. 100 basis points by the end of 2024.
Now, what's the point of equilibrium? Where's it go from there?
The point of equilibrium usually arrives. The Fed doesn't have to go back to where they were pre-COVID for there to be equilibrium. Equilibrium simply happens when enough people are convinced, enough Kevin Bupps are convinced that the market going forward will settle. That's the point of equilibrium, not the actual equilibrium. The point is enough Neal Bawas need to be convinced that the equilibrium will happen. And the moment you do that, that's your bottom, right? Because at that point, everyone jumps into the fray because they believe that going forward, there's going to be, there's going to be better times. And I think equilibrium occurs in either Q3 or Q4 of next year.
Mm-hmm.
And then you start to see a positive, slow growth in 25.
I know we were talking a little bit about before we jumped in here about the build to rent sector. Again, just about the still the inconsistencies that exist in the labor market, material cost of materials, what have you. Give us some insights and updates as to what you're doing there and kind of what the strategy is at this point in time.
Okay, well, a radical change is taking place across America that I think most people haven't noticed. There have been good articles about this, but I don't think enough people are reading them. So if you look at the history of America last 20 years, the home ownership rate sort of moves between 61 and 64%. So it sort of stays in a range, goes up and down depending upon recessions. Essentially what that means is close to 2/3 of Americans live in a home that they own, right? And 37, 38% of Americans basically rent in some shape or the other. Maybe it's a single family home, maybe it's an apartment. So that number, let's just call it 100 million people, right? It's a little more than that, but 100 million people rent. Now, here's what's happening that's new. This is something that wasn't even happening 5 years ago. 5 years ago, if you were a family with dual income and you were in the $70,000 to $80,000 range in smaller markets or $90,000 range in the bigger markets, you would rent for a few years and then you would save enough money and then you would buy a starter single family home and then you would basically keep upgrading every 5 to 10 years. And that was normal. That was the American housing dream. And it was still intact as of 2025, 2015, 2016. Unfortunately, today the divergence is that that dream is shattered for those middle Americans. Rich Americans still live in homes, they always will. But the middle Americans, the 70,000s in the smaller market or 80,000 or 90,000 in income in the bigger markets, they need roughly 88% increases in their salaries to buy a single family home. And because single family homes in the United States are massively locked in at under 3%, and remember, that isn't a short-term phenomenon. My home is locked in at 1.75%. I'm never leaving, right? 1.75%.
I know. It's
right?
crazy.
It's ridiculous. So once you lock in a home at such absurdly low rates, let's call it 3%, and now you have rates at the current mortgage rate is about 6.75%. It's going to take a very, very, very long time for Americans to loosen up and start moving away. And so mobility in the United States has slowed to a crawl because of this crazy phenomenon of having 50 million homes locked in at a ridiculously low interest rate that we're never going to get to again. That has long-term consequences. And the biggest consequence is it holds up home prices because there's no inventory. Nobody's basically moving around, right? So the Americans are moving way, way less. We're almost becoming like Europeans. They used to move like, we used to move 4 times as often as Europeans. Now it's like 1.5 times, right? And because of that mobility changing, because of all these locked in prices, home prices have a cushion under them, right? All these predictions from CoStar, home prices are going to go down 22%. Goldman Sachs, home prices are going to go down 7%. What's happened? They've gone down 1 to 2%. So that cushion is permanent and is there for the next 5 or 10 years. So in the meantime, what that means is we're going to have extremely high home prices and high interest rates, not ridiculously high. I'm predicting that they'll come down. The combination of those mean that the gap between the mortgage and rents is the highest in history. The gap between what people would pay for a starter home mortgage and what they pay for rent is by far the highest in history. Google this. There's lots of graphs that tell you it was not this high in 2006. It was not this high in 2007. And it hasn't been this high since the Second World War. Because of that gap, now you have a bunch of people who have families. They have 2 dogs and 3 kids, and they're forced to live in apartments because they can never buy that starter home. And the rents for those starter homes, because the prices are so high, are also above their levels. So a new industry has emerged to satisfy this group of Americans. There are numbers that vary, but some people say it's 8 million families. Some people say it's as many as 18 million families that don't want to live in apartments. And apartments are always going to be a bigger asset class, right? The majority of those 37% of people have no choice but to live in apartments, so nothing wrong with that. But now you have this in-between group that wants to live in a home but can't afford it. And that's this new industry that started in 2015 with one property in Phoenix from a developer called Christopher Todd.
Yeah.
Christopher Todd built a 300-unit community called Horizontal Multifamily in suburban Phoenix. And everyone immediately realized this asset class is better than multifamily because no one was leaving. Kevin, these people think this is their home, right? So they've got a backyard, they've got a front yard, tiny backyard, tiny front yard, no neighbor above them, no neighbor below them. They've got a garage. And people realized no one's leaving. And Chris Todd is going and building another property and another property and another property, and all of them have ridiculously low turnover. And obviously, profits are exquisite. So Chris Todd is like saying, hey, I've got the best things since sliced bread. And $75 billion of institutional money over the last 5 years pours into this market. And that market is built to rent. And then construction costs went up, so almost everyone stopped building small single families, sort of in a big cluster, and everyone went to townhomes. So that's what I'm doing. I'm building 10,000 townhomes. I can't afford to build them in any primary market. Doesn't work. I can't afford to build them in 90% of secondary markets. Doesn't work. So I'm building them in 10% of secondary markets and dozens of tertiaries. And that's my mission in life. I call it Mission 10K. You can check it out at mission10k.com. I think this is a change for America.
Yeah, no, it's a very interesting space. Very intrigued with it. I've got capital in the space, so I know it and understand it very well. And and I think another key aspect of just some of the reasons behind why residents don't turn maybe as much in these built to rent communities as they might in the traditional multifamily is I think single family historically, prior to like invitation homes coming in and gobbling up tens of thousands, hundreds of thousands of homes. Prior to that, it was a mom and pop cottage industry. I mean, you had individual mom and pop landlords that leased out a home or two or three, but it was very inconsistent in nature. You didn't really have professional management. You had mom and pop third party management companies, things of that nature. But I think the professional nature that's been created, and just some of the amenities that go into these communities, Christopher Todd communities, and the many other built to rent communities out there, it's leaps and bounds above what renting a single family home or even a townhome looked like 20 years ago. It's just a completely different experience for that renter than
significantly better experience, right?
Yeah,
because
absolutely.
They've got like Chris Todd communities, you've got the pool, you've got the gym, you've got a very large central park with artificial turf. I mean, it's almost half the size of a soccer field, and kids are playing there. Right? And your single family home is wrapped all around those places. You've got your own parking spot, so you're not parking on the street. The experience is the new replacement for the American dream. And I think that my prediction is simply this. We build about 350,000 apartments in this country every year. I think going forward, 10% of that is BTR.
Mm-hmm. Yeah, I don't disagree.
10%.
Yep.
Right.
So are you building? You said you mentioned you're not building today, or I guess you are, but not primary, not secondary, but more so tertiary markets. But I know before we jumped in here, you also had mentioned that you've seen a huge discount in land prices. So you're really aggressively land banking at this point in time. Maybe speak to that a little bit if you would, Neal.
Yeah. So in boom times, let's say in 2021, everyone thought that their land was actually plated with gold. And so if you wanted to buy a piece of land for build to rent or by building an apartment, you basically had, 120 days to do your due diligence and basically close on it, and was hideously expensive. And you had to go, $100,000 hard, in the first 30 days. And then, I mean, it was just, I felt like somebody was, grabbing my balls and then squeezing me for 4 months. And at the end of that time, I was basically overpaying. So today, the situation has changed radically. You heard my numbers, right? Retail down 57%, office down 48%. The same thing is happening to land, because land, unlike retail or office, many of those, they've got tenants, so they've got cash flow. And so even as the valuation goes down, they can hold on, right? Because they've got some cash flow to live with. Land doesn't have any cash flow, but it has taxes. And those taxes across the United States have gone up by almost 30% in the last 2 years. So already the problem was you were paying taxes. Now you're paying much more in taxes, especially in Texas and Florida, where taxation has gone completely insane. And so as a result, today, I am in this astonishingly amazing position. This is in August 2023, where I have a team of 4 people running around the United States in over 30 cities. Right now, I got a text from Daniel, who's my lead, and he's in Oklahoma City and wants to show me a piece of land. Bottom line, not only is it 50% off its peak prices, but instead of closing in 4 months, I now have the ability to put down a $15,000 to $30,000 deposit on a 10-acre piece of land where I can build 130 built to rent or 200 apartments. And I have 6 months to basically, for that money to go hard, $15,000 to $30,000. And then I have another 11 months to continue working on the land and not close because the city hasn't approved me. So if the city approves it, then I have to close. But now I have another 11 months. So basically I have a 17-month time frame where I'm only in for 30 grand, maybe another 20, maybe another 30 grand for, the entitlement zonings, doing some initial, architectural work. For 60 grand, I can control a piece of land that allows me to build a $30 to $40 million property. It's freaking insane. You know how many I'm putting into contract? Dozens.
Well, that's exciting.
By the way, I'm not going to build dozens of these properties. My point is, I'm going to pick 17 months from now, I'm going to pick the ones where the cities are booming the most, values have recovered the most, and I'll build maybe 40% of them. And the remaining 60%, which are not bad sites, right? I'm simply going to sell those with plans, with permits, with construction documents, with a builder. I'll create a beautiful package on my website that has every piece of information that people need to see, and I'll send it out to my hundreds of thousands of investors with people having 1031 pain, and somebody will just buy those from me.
Absolutely.
And so I can basically bank $1 million in profit for dozens of sites. And if I don't sell them, what's the harm? I'm not a land banker. I'm a developer. I'll just build them. Right? Land is dangerous for people that can't build. But given that I have 16 employees whose job it is to build properties, what's the worst case scenario for me? I'll just build them. Just wait for a while and keep building them.
What do you think the timing is as far as when's it going to be the right environment and things have enough stability to where you're going to actually start coming out of the ground again?
So I believe, and a lot of my Texas projects, are paused right now. And I've told my investors, guys, I will not take on double-digit debt. I'm playing with your money when I do that, right? The smartest thing to do is to pause for a year and then check, and then maybe pause for another 3 months or maybe another 6 months. So my answer is, in certain markets, construction activity will become optimized again in about 15 months. In other markets, it will take 18 months. And there might still be markets that it takes 21 months. So we're talking about 5 quarters, 6 quarters, or 7 quarters to optimize construction. Smaller markets tend to recover faster because they were not as bubbly before anyway. And smaller markets, construction costs tend to come down faster than larger ones. So like Austin might take 18 months to recover, but other markets might take 12. And there's still other markets in the United States like Rogers, Arkansas, that I can build today.
Yeah, let's talk about that real quick. And I know that I want to be conscious of the time here. We got about 6 or 7 minutes, but I want to get your perspective on not necessarily Rogers, Arkansas. We can definitely talk about that, but how you arrived at Rogers, Arkansas.
There are 323 MSAs in the United States. For the last 10 years, I have a team of people that have been tracking them, and we track about 100 numbers in those. When we became developers in 2016, we started tracking development numbers in addition to demographic ones. So what we do now is we rank cities in the United States, both from a demographics perspective, which I think most of you are aware, population growth, job growth, income growth, home price, schools, etc., usual stuff. And then we also track them for their feasibility and viability for construction, because pockets open up. The cost of constructing a townhome in, let's call it Austin, is close to $190 a square foot, and the project will take 5 years. The cost of constructing a townhome in Rogers, Arkansas is $128 a square foot instead of $190, and it takes only 26, 27 months to build instead of 5 years, 4 to 5 years. So you get a massive increase in velocity, and you get a massive increase in, massive decrease in cost. If you look at property taxes in Bexar County, which is San Antonio, property taxes are 1.53%. You know, Rogers, Arkansas is at 0.35. This
Wow.
means this means that dollar for dollar, townhome for townhome, you only pay 23% of the property taxes in Rogers as you would pay in San Antonio.
Hmm.
23%.
That's crazy.
That's a saving of 77%. Now, take these two examples, construction cost and um, property taxes, add another dozen parameters, usual things like what's the cost of insurance, what's the cap rate, what's the availability of builders, what's the price of land. As you can imagine, land in Rogers is ridiculously cheap, like ridiculously cheap, right? And so you rank those for 323 metros and sort them, and you come up with a bunch of metros in the United States that no one's ever heard of that are astonishingly good for build to rent. And by the way,
Yeah.
I'm not building build to rent there. I'm land banking.
Right. Right. No, I just looked it up on the map. So I am very familiar with Fayetteville and Bentonville. So I see that Rogers is kind of sandwiched right in between the two. So now that
That's right.
makes a lot more sense. That makes a lot more
Correct.
sense.
So
For those
what's
that aren't
happening
aware,
there?
that's
Yeah,
Walmart's headquarters.
that's right.
They're in Fayetteville or Bentonville, one of the two.
Bentonville. So
Bentonville.
what Walmart did recently is they did something very nasty. They basically said we cannot afford to have headquarters throughout the United States. We are a low cost provider, and Amazon's killing us. So they're forcing 13,000 mid-level executives to move from all across the United States into Rogers and
Wow.
Bentonville. 13,000. These are not people that are, in their stores. This is management, right? So it's mid-level management. They're saying we have to consolidate. Our cost of mid-level management is killing us. Our margins are 3%, and Amazon is fine with 2%, and that's killing us. And so we've got to consolidate. So they're forcing their mid-level management into Rogers.
Interesting. Well,
And
that's a
by the
great
way,
influx. Yeah,
yeah,
that's a perfect ingredient for build to rent and new inventory. So
exactly. And,
love
and
it.
again, I'm not building expensive built to rent homes. My
Yeah.
my built to rent homes in Rogers are going to have $1,700 a month in rent. So you're paying
Mm-hmm.
$20,000 a year. So if you have an income of 60 or 70, then you're in good
Yep.
shape.
Yep. No, fantastic. Well, Neal, I feel like I could continue talking for another hour or two. Just a wealth of information and lots of valuable insights that you've shared. So I appreciate you coming on here today, and we'll have to do it. I looked back at when we were last on the podcast together. It was like 4 years, so we'll have to try to make it a little bit shorter time frame than that, because I feel like there would be a lot of changes that ultimately will occur here over the next year or two. And so with that, I appreciate you coming on, my friend, as always. And I'm sure our paths will cross at some point here at a conference now that they're happening again after COVID. But but thank you again, my friend.
Thanks, and thanks for having me on, Kevin.
Alrighty, guys, that's all we have for this week's show. So until we meet again next week, this is your host, Kevin Bupp, wishing you huge success. Take care now.